If you're looking for clarity in a noisy market, this one's for you. Tom Lee just sat down on CNBC and said, markets still have a lot of tailwinds into year-end. He's the head of research at Fundstrat and CIO at Fundstrat Capital, and when he plants a flag like that, I pay attention. In today's video, I'm going to roll the clip, then give you my real-time reaction. What he nailed, what I'm watching, and how I think this sets up the next few weeks. And stick around, because after my breakdown, I'll dive into 2 tech stocks I believe are positioned to benefit if Tom's year-end tailwinds play out. If you only watch one investing video today, make it this one, and watch to the end so you don't miss the tickers, the thesis, and my risk management plan. Do me a quick favor before we jump in. Tap like, we're shooting for 1,000 on this one. Share it with a friend who's been sitting on the sidelines, and drop your take in the comments. And if you're new here, hit subscribe so you never miss the next big market update. Alright, let's roll the clip and hear exactly what Tom Lee had to say.
I'm kind of more in the Jamie Dimon camp, that, and Steve Leisman's point that there's opacity in private credit, and that's the problem that investors are going to grapple with for some time. And I think that, along with the trade tensions and, the VIX spike, is the reason investors are a little cautious. But I don't think that's going to change that markets still have a lot of tailwinds into year end. And part of it is AI is like, I think demand is accelerating there. And we know that investors are sitting on a lot of cash, and institutional investors are really having a terrible year. Only 22% are beating the benchmark. So I think there's a bit of a chase. And then sentiment has flipped negative, which is always a contrarian buy signal. So, I think despite this mounting wall of worries, including the shutdown, I think it sets us up for a pretty good rally into the end of the year.
It sounds, though, like this is enough on your radar that do you think it's at least changed the game in the near term for the market?
On the private credit?
Just overall. I mean, if there are continued issues in private credit and the leveraged loan market, then the stock market's not going to take that well. I mean, you wouldn't think.
Yeah, I mean, Scott, the only thing that I don't know is how many chapters it's going to take to play out, because, there's opacity, which is what is scaring people, but then there's real credit deterioration, which I don't think that's what's happening, and I think that's why Adam and all those had called it idiosyncratic. I'm kind of in that camp because high yield spreads have behaved. So I think it's more of is the flow of capital, because I think one of the biggest sort of allocations for alternatives has been private credit. It's going to make investors pause that, maybe this market it's not as easy a return as it looks.
You told me, I think, a couple of weeks ago that 7,000 on the S&P by the end of the year was realistic. You still think that we could get another 5%? That's what it looks like. It's 5% between now and then. Do we have that in us?
Scott, I mean, 5% is just an average fourth quarter from 1950 to 2024. But we have the Fed easing after an extended pause. So that's 1998 and 2024. So I think that 5% might be the base case. I bet you it's going to end up being more like 7 or 8% or even possibly 10%. So I think 7,000 is the low end of what we can end the year at.
Wow. And how much do earnings have to do with that?
I mean, earnings are going to matter, but it's been a good start. I mean, we're barely into earnings season. The banks have been good. 82% of companies are beating. There's a lot more visibility of demand and then less concerns about tariffs because we're kind of working our way through it. So companies have a better sort of visibility over the next 12 months. I think the outlooks are going to be good, and I think that's going to help stocks. And, I think there's a lot of room for multiples to still expand. So I don't think this market's that demanding.
I think it's interesting that you suggest that you'd be a buyer of regional banks and small caps. Why are you willing to do that? That's not putting your toe in the water. That's like putting the bathing suit on and jumping in. Why?
Well, I mean, Scott, I know there's a lot of muscle memory for people from 2023, and that was because of a big change in rates that really caught a lot of banks offside just in their business model. But that doesn't mean that this crisis, which is underwriting being done properly, should have the same issue. So I think that there has been a throw the baby with the bathwater out on the regional banks and the small caps. So yes, I think despite the fact that the Russell had a rough week, I think they're really going to be one of the beneficiaries. I mean, even on earnings basis, small cap earnings are going to grow 48% in the third quarter. That's like 5 times bigger than the S&P. So I think there's still a lot of growth left there.
What Tom is really saying is this: yes, there are real reasons for caution right now. Private credit opacity, trade tensions, a jumpy VIX, even the political noise around a potential shutdown, but the market still has enough fuel for a meaningful push into year-end. His view isn't blind optimism. It's the classic wall of worry setup where positioning, seasonality, and an improving earnings picture could overpower the headlines. Let's start with the private credit issue, because that's where the anxiety sits. Tom basically aligns with the Jamie Dimon camp and Steve Leisman's point: there's opacity in private credit. Translation: investors don't have the same clarity on risks and marks that they do in public markets, and that unknown can spook people. But he draws a sharp line between "we can't see it clearly" and "it's blowing up." He's not seeing broad credit deterioration. High-yield spreads, which usually sniff out real stress, are behaving. So, his read is that what we're watching is anxiety over transparency and flows, especially because private credit has been one of the hottest alternative buckets. The likely result is a pause in new allocations and some second-guessing, not necessarily a systemic domino fall. That distinction matters. Fear of the unknown can elevate volatility, but it doesn't automatically rewrite the earnings and liquidity backdrop for stocks. And that backdrop is the core of his bull case. First, positioning. He points out that institutional investors are having a rough year. Only about 22% are beating their benchmarks. When pros lag and cash levels are high, you get chase risk. Managers are incentivized to buy dips and reach for performance into year-end. Pair that with sentiment turning negative, traditionally a contrarian tell, and you've got dry powder plus a psychological accelerant. Second, AI demand. He's explicit that the AI cycle isn't slowing. In his words, demand is accelerating. Whether you agree on the magnitude, the point is, he sees AI as a multi-quarter tailwind that keeps earnings expectations buoyant and capital expenditures elevated, both supportive for equities. Now, the calendar and the Fed are doing him favors. He calls out that a 5% fourth quarter is the long-term average from 1950 onward. That doesn't guarantee anything, but it sets a baseline. Then he layers in what he calls Fed easing after an extended pause, invoking years like 1998 and 2024, periods where a policy pivot or relief provided oxygen to risk assets. In that context, he doesn't just stick with the baseline, he goes bigger. 7-8% or even 10% for the rest of the year isn't off the table in his view. That's how he lands on 7,000 for the S&P as a realistic year-end print, and he even calls 7,000 the low end of the range. Bold, yes, but it's consistent with his setup. Negative sentiment, underpositioned pros, cash on sidelines, seasonal tailwinds, and a friendlier policy backdrop. Do earnings have to cooperate? Absolutely, and he says they're doing just that. We're early in the season, but banks have been solid, beat rates are high, and, importantly, companies have better visibility into the next 12 months. The tariff talk, while not gone, is less of a fog than it was a few weeks back, which helps CFOs put forward cleaner outlooks. When outlooks improve, multiples can expand without feeling reckless. That's why he says this market isn't that demanding. He's basically arguing that if earnings hold up and visibility improves, the market can pay a slightly higher multiple into year-end without straining credulity. Let's address the part of his call that will raise eyebrows: buying regional banks and small caps. He knows 2023 scarred a lot of people. The rate shock exposed asset-liability mismatches at some banks, and that muscle memory is real. But he separates last year's duration hit from today's underwriting questions. In his view, the current worry cycle isn't the same structural balance sheet risk. It's about how credits were underwritten and whether pockets of stress are idiosyncratic rather than systemic. He also thinks the market has thrown the baby out with the bathwater, selling the whole complex on fear rather than fundamentals. That's why he highlights small caps despite a rough recent stretch for the Russell. He expects them to be beneficiaries if growth holds, financial conditions stabilize, and risk appetite returns. He even cites small cap earnings set to grow 48% in Q3, 4 to 5 times the S&P's pace. If that relative earnings surge shows up on the tape, it gives legs to a catch-up trade. Now, where could this go wrong? He admits there are chapters left to play out in private credit. If opacity morphs into true credit deterioration and spreads start to widen decisively, the equity market won't shrug that off. If trade tensions re-escalate into something that crimps margins or disrupts supply chains, that better visibility he's banking on fades. And if the VIX spike turns into a regime shift rather than a scare, the chase can get derailed. But his point is, those are risks, not base case outcomes right now, and the tape plus macro tell him the path of least resistance into December still leans higher. Here's how I'd translate his framework into a practical playbook for viewers. First, respect positioning and seasonality. When a lot of pros are behind and it's Q4, dips can get bought faster than they should. Second, watch the credit dashboard as your tripwire. High-yield spreads, leveraged loan pricing, and any clustering of defaults or downgrades. If those stay orderly, the bull case breathes. Third, lean into what's working, but broaden the lens. Core AI leaders remain the market's engine in his view, yet he's clearly rotating some attention to laggards like small caps and regional banks that could mean revert if earnings beats and guidance breadth continue. Fourth, listen to outlooks, not just beats. The moment companies start guiding cleaner for the next year, multiples tend to stretch without a revolt. Finally, stay honest about the risk calendar, policy headlines, shutdown chatter, tariff noise, and separate signal from sound. He sees them as worries that ironically set up rallies when they don't escalate. My take on his 7,000 call, it's aggressive but not crazy if 3 things line up. 1. The Fed tone remains incrementally supportive. 2. Earnings revisions don't roll over. And 3. Breadth improves, meaning we see participation widen beyond the mega caps. On small caps, I'd add a nuance for all of you. Quality matters. If you're fishing in the Russell, stick to positive free cash flow, manageable leverage, and proven pricing power. It expresses Tom's thesis without taking shotgun risk. On regional banks, think capital strength and deposit resilience first. There's a difference between inexpensive and fragile. And for the AI angle, be mindful of second derivative plays, semis, infrastructure, and software enablers, because Tom's accelerating demand comment suggests the spend cycle keeps rippling outward. So, if I boil Tom's interview into one sentence for you, the market's biggest near-term risk is narrative-driven opacity, but the biggest near-term force is performance chasing into a supportive seasonal and earnings window, advantaged by an AI demand curve that hasn't cracked. That tension is why he's leaning bullish even on controversial pockets like small caps and regionals. If the credit gauges stay calm and guidance stays constructive, the path he laid out, something closer to 7 to 10% into year-end, stays live. If those gauges flare, you'll know quickly, and the plan shifts from riding the chase to protecting capital. That's the lens I'll be using the next few weeks. Watch spreads, watch earnings breadth, watch guidance tone, and watch whether dips get reflexively bought. If those keep lining up the way Tom expects, the wall of worry doesn't block the market, it becomes the staircase. Alright, first up, let's talk about something that sounds like it's straight out of a science fiction movie, quantum computing. The company is IonQ, ticker IONQ. They're a pure play on quantum. This is their entire business. That kind of focus can be what it takes to pioneer a new industry. What even is quantum computing? Quick breakdown. Your phone and laptop use bits. Bits are either 0 or 1. Quantum computers use qubits. A qubit can be 0, a qubit can be 1, or both at once. Superposition. Like a coin that's both heads and tails until observed. That lets quantum machines explore huge numbers of possibilities in parallel. Not just faster browsing, solving problems classical computers can't. Designing new drugs is a prime example. A complex molecule has countless interactions. Classical supercomputers could take thousands of years. Quantum could do it in hours or days. That could transform medicine. That could transform material science. That could transform financial modeling. Enter IonQ. They specialize in trapped ion quantum computing. They use lasers to hold individual atoms. They use ions in a vacuum chamber as qubits. Competitors use superconducting circuits. IonQ says trapped ion yields more stable, higher quality qubits with fewer errors. Qubit count and quality matter. More and better entangled qubits equals more power. IonQ has been increasing both qubit counts and quality. They use algorithmic qubits or number AQ as a real-world benchmark. How do they monetize? via cloud access, Amazon Web Services, Microsoft Azure, Google Cloud. Cloud partnerships lower the barrier to entry for customers. That has led to early commercial orders and strategic collaborations. Hyundai Motor Company is exploring better EV batteries with IonQ. They're working with financial firms on optimization, and with government labs. IonQ, at a market cap of $24.39 billion, is still in the early commercial phase with 2024 revenue of $43 million. Earnings per share come in at negative $2.06, and net income sits at a loss of $331.64 million. That profile tells you the story. Investors are paying up today for long-dated quantum computing potential, while the income statement is very much in investment mode. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks, but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now for our second pick, we're shifting gears from the quantum realm to something much more tangible. Alright, our second company is Applied Digital, ticker APLD. If IonQ is a bet on far future tech, Applied Digital is a bet on here and now infrastructure. They're a specialized real estate company for the tech world. They design, they build, they operate large-scale data centers for high-performance computing. They started with facilities for digital asset mining. Crypto mining is incredibly volatile, but APLD is pivoting. They realize their infrastructure, massive power capacity and advanced cooling systems, fits AI workloads. What powers ChatGPT and AI image generators? An army of GPUs, mostly from NVIDIA, running in data centers. These chips use enormous electricity and generate massive heat. Demand for high-density data center capacity is exploding, and supply is tight. This is the Applied Digital thesis. They own the physical buildings, they own the power infrastructure, they own the cooling systems, they lease space and power on long-term contracts for recurring hosting revenue. They build where they can access cheap, preferably renewable power. Example, a massive data center campus in North Dakota with low-cost wind power. For AI customers, cheaper power is a major operating cost advantage. They're moving up the stack to offer AI-focused cloud services. They announced a cloud platform renting thousands of NVIDIA H100 GPUs hosted in their facilities. That could push them from landlord to higher-margin service provider. On valuation, asset heavy. You can value them by replacement cost of data centers. The stock is beaten down from mining history and financing worries. But assets might be worth more than market cap. A turnaround argument. Signing large AI customers could flip sentiment fast. Now, the risks. Debt, massive capital needs and heavy financing obligations. Customer concentration, legacy exposure to mining. They need to diversify. Their AI cloud has an anchor customer, but they must sign more clients to de-risk. Energy and regulatory, power price spikes or new rules could hurt margins. Competition, big incumbents with deep pockets and existing relationships. Applied Digital carries a $9.57 billion market cap, posted $136.61 million in revenue for 2024, and, like IonQ, remains unprofitable with EPS at negative $1.01 and net income at a loss of $149.27 million. The takeaway here is straightforward. These are speculative growth names, one centered on quantum hardware and services, the other on AI-focused compute capacity, with valuations that imply faith in future scale. If you're considering them, size positions thoughtfully, know the cash burn, and understand that execution against those revenue ramps is the needle mover from here. Bottom line, Applied Digital is a speculative picks and shovels AI infrastructure play, high upside, high risk. So, there you have it. Two very different, very speculative tech plays that could have some serious explosive potential. On one hand, you have IonQ, a pure play bet on the paradigm-shifting technology of quantum computing. It's a moonshot with an almost sci-fi level of upside, but with a long, uncertain and expensive road ahead. On the other hand, you have Applied Digital, a tangible, asset-backed infrastructure play that's trying to pivot and capitalize on the here-and-now explosion in demand for AI data centers. It's a turnaround story with significant debt, but also with hard assets you can point to. Both are high risk, but they offer a glimpse into two powerful trends shaping our future. Now before we wrap up, if you want to take your investing game to the next level, I've got something for you. Exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides. Join the StocksGalore Patreon today and take your investing game to the next level. Our members there get full in-depth analysis on most of these stocks I mention here. Head over to patreon.com/StocksGalore and become part of our growing community of smart investors. The link is in the description below. It's a great way to support the channel and get a ton of extra value. I'm really curious to hear your take on this. Which of these two plays, a quantum computing pure play, or an asset-backed data infrastructure operator would you pick for a long-term position, and why? Tell me which one and your top reason in the comments below. Let's get a good discussion going. As always, thank you so much for watching. Don't forget to like, share your thoughts in the comments, and subscribe to the YouTube channel so you don't miss out on the next important financial investing update. Thanks for watching, and I'll see you in the next one.